Well, I think it's important to remember that for U.S. investors, even though the U.S. market is so big and so important, there is a world of opportunities out there. And you don't actually have to go that far afield before you can start getting some differentiation and getting exposure to world-leading companies that you wouldn't get in U.S. markets without necessarily going up the risk curve as you would going to some markets farther afield. There's nothing wrong with an exchange-traded fund, a passive vehicle, if you're investing in something like the S&P 500. That's a very large, very liquid index, and that makes perfect sense. Once you leave the United States, all of a sudden things look a little different. You know, if you go to Toronto, you look at the TSX index, it can be dominated by the big 5 banks. And once in a while, this happens periodically, is dominated by one company, the return. And you really wouldn't want that exposure. And if we look back at some of those companies, you know, most recently it was Valiant, before that it was Potash, before that it was Research in Motion. We've had different ones where you think, oh, maybe I didn't really want that big an exposure to any one company. So it makes more sense to get some active management. You can get a more diversified exposure and get exposure to companies that aren't on the headlines where you can actually add value. I think the main thing about closed-end funds is because it is a structure as opposed to an asset class. The structure allows you to get access to assets that don't work well in other structures. Those typically can be things that are illiquid, things that are a higher risk, or also if you're just looking for enhanced yield. Because they can employ leverage. So it basically comes down to your normal fundamental questions. What's my time horizon? What's my risk profile? And what are my aims?